It will be from the perspective of rating agency. Okay, I'll deal with it in French.
Okay.
For nearly 2 years, the world is trying to live with the COVID-19 pandemic. We're still at the worst of the medical emergency, with an immense impact on the economy. Across Africa, the pandemic is expected to push 40 million people into extreme poverty. Debt burdens are likely to rise by 10 to 15% points in the short to medium term. Business as usual is not an option.
Africa will need an additional $425 billion in external funding between now and 2025 to fully recover from the pandemic. Economic governance and creativity have to be part of the financing solution.
So increasingly, Africa is looking to capital markets as a source of financing. And this is really the new way in terms of how the financing structure or landscape of Africa is going to look like going forward.
To succeed, African countries need to think whole. Improving domestic revenue mobilization, transparency and accountability, and public finance management, and overall macroeconomic policy governance will go a long way to improve the financing for development in Africa.
It is time to find innovative solutions to sustain growth, to rethink development financing models, to strengthen regional and continental integration. Welcome to Cabo Verde. Welcome to the African Economic Conference, where the bold discussions will be held to finance Africa's post-COVID-19 development. How should Africa prepare for post-COVID-19 recovery and transition? Do African countries' financial systems fit the reality? Why have decades of spending had such a small impact on improving the lives of the poor? What would be the next normal for digital transformation after COVID-19? Jointly organized by the United Nations Development Programme, United Nations Economic Commission for Africa, and the African Development Bank Group, the conference calls for a radically new approach. A platform to take new ideas on board, to bring positive transformation, to find new solutions and meet the Sustainable Development Goals by 2030, to rethink our economies and redesign our future. Because now more than ever it is possible to think about change, to foster innovation, to build Africa one idea at a time.
Good afternoon. Good afternoon, Excellencies, distinguished panelists, distinguished ladies and gentlemen. I think we are kicking off the 6th plenary session which is on are bonds the right instrument for development financing? I know this is more or less a virtual session because almost all the panelists are really participating virtually. They're not physically there with you, including me, that is moderating from Pretoria, South Africa. But I just want to let you know that we have some distinguished panelists that will be able to deal with the issues that we intend to really address within the next 55 minutes or so. But I just want to let you know that based on what I have with me, we have 3 panelists here. Just to let you know, my name is Ayo Odushola. I'm the UNDP resident representative for South Africa and the director for African Finance Sector Hub based here in Pretoria. Here to really contribute to the theme of our discussion this afternoon, we have 3 panelists. We have Mr. Hubert Danso, CEO and Vice President of the Africa Investor Group. I'm not too sure if Hubert is with us right now. Hubert, are you there? I guess he's still not yet connected, but we have Mrs. Soraya Diallo from Bluefield Investment from Cote d'Ivoire. Mrs. Diallo, are you there?
Yes, good morning, Ayodele. I'm here.
All right. We also have Mrs. Weyimin Omamule, who is the senior economist, the UNDP Tanzania. Are you there?
Yes, hello everybody, and good afternoon from Tanzania.
Yes, thank you very much. I think let's try as much as possible to go. Now, the opportunity we have is that instead of 5 panelists that were originally scheduled, I think we have effectively now 2, so that will provide opportunity for us to have enough time for discussion and also to engage the participants right there and those that are joining us virtually. I think it's really very important for us to see how we take this initiative to the next level, particularly when it comes to the issue of the question we're asked, are bonds the right instrument for development financing? But just to let you know that when it comes to the issue of local capital market anywhere in the world, they are key to growth and development, depending on how countries effectively utilize them. Particularly, capital markets are important sources of diversifying financing for development, whether in the form of loans, bonds, debentures, and equities. Also, they help a lot in terms of helping to really crowd in additional investment from other private sector actors. It also helps to really reduce dependence on aid and foreign loans. Particularly, we are all living witness of what happened in Sri Lanka about a few years ago, where the port of Hambantota was seized as a result of not being able to really pay the debts that were owed to a particular creditor. And also, about a week ago, there is the news that there is possibility of one of our international airports in Eastern Africa to be seized because of the inability to redeem the loans. So there are a number of things we thought we need to really find a way of making sure that we diversify the sources of financing for development on the continent to be able to avoid all these challenges that are associated to overdependence on foreign loan. But one thing that is very important is that despite the fact that we have 36 security exchanges, stock exchanges in 43 African countries, the level of capital markets in Africa is highly underdeveloped, not only in terms of scale, participation, and debt, but also it is over-concentrated in just about 5 countries: South Africa, Nigeria, Kenya, Egypt, and Mauritius. And by the time you remove those ones from the equation of capital market, it's extremely very weak. And there's need for us to really see how do we deal with this and why is it underdeveloped on the continent. One, the smallness of the economy. Two, the weakness of macroeconomic as well as macroeconomic and business environment, and also the issue of quality of institutions. But one thing that is really very important, which helps us to really take this initiative forward, is what we have experienced in terms of the expanding trend of bond issuance, which on the basis of the previous session, it has moved from about 24 billion in 2019 to about 73 billion in 2020, which again is a very, very dramatic expansion. And there has been a lot of different types of bond issuance, whether in the form of Eurobond, in the form of infrastructural bond, a diaspora bond, green bond, blue bond, and even social bond. So these are things that are more or less becoming the norm on the continent. But we have about 2 questions to ask ourselves before we go to the real discussion. Is the participation of government using the government security market, is it not crowding out the private sector security market? That's one key question. And if it is doing that, how do we ensure that this is not the case in moving ahead? 2, there seems to be some kind of paradox of capital in Africa, in the sense that we have capital that are suboptimally utilized or that are currently dormant. For instance, one of the work that UNDP is doing, she really shows that dormant and suboptimally utilized capital in Africa is about $1.1 trillion. This takes the form of insurance premium fund, sovereign wealth bond, the issue of pension fund, and external reserves in our central banks, as well as the bank unutilized funds. So if you have almost about 30% of the current GDP dormant or suboptimally utilized, and we're all running around to get something that is more expensive to develop our capital market. Why is this so? These are questions which I think we need to really use in guiding the discussion. But essentially, there are going to be about 3 questions. The first one is the market infrastructure conducive for efficient government securities markets in Africa? That's the first one. The second one is what could drive institutional investors, domestic saving, international investors to have more interest in Africa's government security markets. The third one will be what role will the rating agencies play in Africa with sovereign credit rating to increase performance of government security market? So these are key questions which we intend to use in guiding the discussion. And perhaps, let me just start. I wouldn't know if Hubert has already joined us. Hubert, are you there? Yes, okay. Well, let's kick off. But I just want to also acknowledge our rapporteurs. We have Abdoulaye Jane, our national economist, UNDP in the Gambia. And also we have Mrs. Mabulara Suene, also a national economist in UNDP. So, and I'm sure you are all ready for the panelists to kick off the discussion. So let me use this opportunity to call on Mrs. Soraya Diallo, who is from Bloomfield Investment from Cote d'Ivoire, to help us really address the issue of what could drive institutional investors, domestic savings, and international investors to have more interest in Africa's government security market. Over to you.
Well, thank you, Ayodele. Well, as you said, I am Soraya Diallo. I'm from Bloomfield Investments, Senior Vice President and Director of Bloomfield Ratings. Bloomfield Investment is a rating agency that has activities all over West Africa, Central Africa, and some activities too in Europe. If I can get back to your question, the fact is that let me talk about YMU. This is the zone that I know the best. The investments on the regional stock exchange in OMU, the BRVM, have been subscribed by banks that are the local investors, also by insurance companies, and also by international investors. I think that what hampers the international investors from coming to the regional stock markets is more about the perception that they have from the local risk, from the African risk, from the sovereign African risk. And to deal with this problem, to build the confidence between African markets and the investors, there's a couple of steps that must be done. First one is the rating. With UMOA Titre, we have gone through a program, this three years program of rating the regional, the states of UMOA. The 8 states of WAMU have been rated in local currency. And this rating for us are the way to build some of the confidence for the international investors. The other part is for the states to start communicating with the investors about their performances, about their programs, about their ability to use the resources that are given by the investors. It's therefore, as I told you, a problem of perception. The international rating agencies have a perception on the African risk that is really high. We have saw the downgrades that have been done in 2020 due to the crisis, the COVID crisis. But this is opposite to the resilience that has been observed on our regional market. All the countries in WAMU zone have done quite good macroeconomic performances, have been resilient, and have clearly shown that they are not speculative ones. So this puts in place the importance of financial rating in local currency vs what has been done by the international rating agencies. To build this confidence, the government must understand that investors, especially the private sector, do not only expect good performance, but also satisfaction with efficient use. And this is where I think there is still a lot to be done by our countries. We also need to deepen the markets. If our states, Côte d'Ivoire, Benin, Senegal, continue to go on the international market, they're raising Eurobonds this year and in 2022. I think it's not because the liquidity isn't available on the domestic market. There is liquidity, there is sufficient liquidity, but there is not any infrastructure to collect this liquidity. The domestic savings aren't attracted by the market because the population do not know that there are opportunities to invest on the sovereign bonds because they do not know if their investments will be used as they want. And as I said, there is many communication, education, financial education to be done towards the population. The international investors need to know that there is a secondary market where they could exchange the bonds that they have bought, but this secondary market isn't very dynamic yet on the WAMU stock exchange. They also need to know that the framework in place is securitizing. So another thing that we also can propose is that versus to raising bonds only to finance the state's budget, because most of the bonds that are raised are only for financing the budget or financing administration expenses or just equilibrium of the budget. We need to raise bonds for projects so that these projects can generate resources in order to reimburse the bonds. The investors want to be associated with development, with infrastructure development, with resources that are transparently used and that serve really for the development, but not only financing just the budget of the different states. So that's something towards what the states in YMU must be working. I was talking about the program for financial rating in local currency that has been done by UOMA Titre. I think this is an example, a pilot model that can be developed in most countries of Africa. UOMA Titre, as a supervisor, has really led this program and is also the one leading and structuring the interventions of the YMU states on the local stock exchange. And this is done in sort of making these operations more dynamic, building confidence, building also transparency for all the actors of the financial market to be more interested. Other thing in order to deepen this market is to attract, as I told international investors, but also to attract domestic investors that are willing to invest. I talked about banks. That is not their role to invest in the financial market, but they are the main players. Insurance companies that are limited by the regulation. But these last years, most states in YMU have created pension funds, local pension funds that could be the next actors on this stock exchange. So we need to really collect this domestic savings, really collect these domestic investments that are available on the market, but just want to have more confidence in the capacity of the different states to use efficiently and correctly and transparently their funds. That's what I wanted to say.
Thank you very much, Mrs. Diallo, and thanks for pointing out some of those critical issues that we need to look out for. One, the need for African countries to really securitize project-based bonds so that it helps us to really ensure that the resources to redeem such bonds are linked to such projects. I think that's an important thing that most African countries may need to really look into so that borrowing today does not lead to delinquency tomorrow. That's one thing which I think is really very important. And also the need for us to really make sure that we develop the kind of infrastructure that help us to really mobilize those domestic liquidities which cannot be plowed into investment route. So I think that role of intermediation is one of the things that I will come back to you in terms of what kind of infrastructure can we put in place to really mobilize this domestic liquidity into investment fund so that the intermediation process between the deficit and surplus unit of the market agent becomes effectively utilized. And also, I'm so happy that the 8 YMO countries have been rated using domestic currency, which again provide opportunity for building capacity of these countries to be able to know what it takes for the sovereign rating credit agencies' requirements are, and to also push for performance. And also, so glad to know that the issue is not just about performance, macroeconomic indicators, but also in terms of effective utilization of such resources for development initiative. This is something that I think is really very, very important for us. I'll come back to you to find out the issue you mentioned concerning the downgrade of countries versus the rising trend of the resilience of these African countries that are downgraded. That is the inverse relationship between level of resilience and downgrade of countries. So I'll come back to you later. But let me just go back. Let me now go to Wayimi Omamuli, the senior economist in Tanzania, also somebody who has spent decades in rating agencies globally, and who will help us to really address some of the pertinent questions that have been posed by the organizers of this event. Let me just start with the role of rating agencies, the role they need to play in Africa with sovereign credit ratings to increase performance of government security market. That's going to be the first one. And also building on the second one is building on the previous session, the previous plenary session. How can credit rating agencies play a supportive role in Africa's capital market development? So these are things which I know it's part of your DNA before you join United Nations Development Program in Tanzania. So over to you.
Thank you very much, Ayo, for that introduction. I hope everyone can hear me. And yes, I was very interested in Madame Diallo's presentation. I really like the alternative view, because like you said, I worked for an international credit rating agency, Moody's specifically, actually. And it's always very interesting to get the view from the local side that I actually had never been exposed to actually until recently. So I'd like to explore that more. I hope we get into that a bit more. But I mean, I think this question is a very interesting one. And I like to give a little bit of a primer about what credit rating agencies do, because I think there's a lot of controversy around it, and especially in recent years, as you mentioned, Ayo, with the downgrades that followed the pandemic, these calls that the rating agencies are unfair, et cetera, et cetera. Now, I'm going to give a very balanced view. I'm not advocating for what international rating agencies do in any way, but I think it's also important to understand and to give a balanced and fair view about what their role actually is and the limits of those roles. So, we know that because of the financial crisis, et cetera, credit rating agencies have come under scrutiny, and there's a lot of misconceptions flying about what they do, actually how powerful they are, etc. Some true, some untrue. But let's put that aside and try and understand a little bit what a sovereign credit rating actually is and what it's not. So a sovereign credit rating agency, and I'm going to be very sort of idealistic here. So this is ideally a sovereign credit rating is an independent assessment of the credit worthiness of a country or sovereign entity. So it should provide investors with an indication of the probability that what the probability is that a country will default on its debt obligations, and this is based on an assessment of a country's ability and willingness to repay its debt. So, and they use a large array of quantitative and qualitative metrics and factors to determine to make these kinds of judgments. So, for example, on the quantitative side, you have factors like debt to GDP, what the fiscal balance is, the inflation rate, GDP growth, the prospects for GDP growth as well, the trajectory, the current account balance, debt service ratio to revenues, and per capita GDP. On the qualitative side, you have things like, measures of corruption, the level of democratization in a country, the level of institutional development, the judicial system, and then, of course, the history of default of a particular country. All right. So why are credit ratings so important? Why do they hold so much power and so much sway in the popular imagination? Well, they first emerged as a response to the problem of asymmetric information in credit markets. So lenders could not fully assess the credit risks involved in giving loans to particular borrowers, at least not with significant costs. So for every single borrower, you have to do a credit assessment, and it can become quite costly to gather all that information. And then on the other side, borrowers also will find it difficult to convince creditors that they're good credits. You know, you can't just say to someone, "Oh yes, you can trust me, I'll pay back the loan," without actual, independent verification and corroboration. So this is where credit agents come in, and this is their primary function. They should really only be a tool for determining and conveying this message to investors in a systematic way, what the risks involved in lending to a particular credit is. So this is the system that these credit rating agencies, particularly the ones that we know about, Moody's, Standard & Poor's, Fitch, have done. They've come up with a system of grading the risk of different types of credits, and they've come up with a language around that. So we're all familiar with the AAA ratings and then the single B ratings in Africa. These ratings are part of what is known as a rating scale. So you have about 21 different ratings, more or less, depending on the company, in this scale. So you have the AAA, AA, single A, triple B, double B, single B, triple C, double B, double C, single C, and then you have default D. And that's obviously, that's self-explanatory. And then in addition, you have outlooks assigned to each rating. And that tells you the outlook for the rating, pretty much. So the outlooks are stable, positive, or negative, meaning that within a certain time frame, 1 to 2 years normally, the rating, as you see it, is going to remain the same, be upgraded or downgraded, likely, not definitely, but likely. So again, we all know about investment grade. These are AAA to triple B, and everything below double B onwards are considered speculative or junk. And this is where the controversy lies. The majority of African countries are rated in the so-called junk category, single B and below on average. I did a bit of an analysis, and 91% currently, following all the downgrades that happened, of African countries, 91% are single B credits. Only 2 African countries are investment grade, Botswana, Mauritius, actually Morocco, but we're talking about sub-Saharan Africa really. So Morocco is one of them. And as we know, South Africa has been downgraded, lost its last investment grade rating around March of last year after the pandemic. So having said that now, so to answer the question that more directly, what role do rating agencies play by assigning these sovereign credit ratings? They should have a neutral agenda, really. They just should assign the ratings and withdraw. They don't have anything more to do with, they don't have any agenda in terms of development, in terms of being fair to a particular credit. Their mandate should be to the investor, to give the investor information, allow the investor to price risk properly, and then allocate capital efficiently. And we've seen in cases where this hasn't happened. So during the financial crisis in 2008, 2009, we know now that a lot of ratings on mortgage-backed securities were inflated. So a lot of credit, there was a misallocation of capital into these assets that would actually had a higher probability of default. And that's exactly what happened. And lots of investors lost a lot of money. So there can be a lot of losses if credit rating agencies get it wrong. Also, there can be a lot of losses, welfare losses in this case, if they also assign ratings that are lower than warranted by issuers' credit fundamentals. So I think that this is the subtext of this question, really. There is the idealistic view. This is exactly what sovereign rating, credit rating agencies are supposed to perform a market clearing function. Do they actually do that? Do they actually set accurate and fair ratings that actually reflect the true credit worthiness of countries? And this is debatable. When they don't do this, African countries get are charged higher rates for borrowing. Their debt service costs go up, and they can't use that money that they're devoting to paying extra interest to other developmental activities, infrastructure, etc. So it's particularly punitive for African countries that are still developing to be faced with this condition. The market itself imposes a premium on African debt, regardless of what the rating is. So you can do very simple analysis, just looking at the data, comparing countries in the same rating categories in other regions and countries in Africa at a particular level, say single B. And you can see a premium being attached. So two countries rated the same are paying different interest rates, reflecting what the market premium is. And then consider as well, if the rating agencies are assigning ratings that maybe one or two notch lower, this is doubly punitive for African countries. But the question is, on the side, to give a more balanced side of things, more balanced response, the question is, in Africa, have sovereign ratings helped to increase market access, which is what happens when you have less uncertainty about risk, and investors can move forward because uncertainty stops borrowing, stops investment, actually. So the answer is yes. There has been a lot of capital that has been raised on Eurobonds. I think Aya, you mentioned the amount that was raised in the past year. So over the past decade, about $175 billion has been raised by African countries. That's a lot of capital that would not otherwise have gone into these countries in the absence of a credit rating. And the reason for that is because regulators require credit rating agents, sovereign ratings for issuers to have sovereign ratings. Investors require this. So it's a condition that's actually embedded in contracts and in government regulations. And the way regulations have proceeded have made it such that the so-called three big credit rating agencies have come up as the dominant ones, and they're the ones that are focused on a lot in times of crisis, like during the pandemic. So I want to say that I hope I've given a balanced view of what credit rating agencies are supposed to be, what they've done, what they've managed to achieve, and then of course it's very important to understand that bias does take place. And we in the development community need to find solutions for African countries so they don't continue to pay higher rates of interest than they need to pay. So I think that's my time. So I'll just look forward to discussing further with the audience. Thank you very much.
Yeah, thank you very much, Wenyemi. I think you have really touched on the key issues. But let me pose one or two questions to the two of you. First, there has been a lot of discussions that credit rating agencies are extremely biased against African countries, and that they often use what they call the Western indicators that are at variance with developing countries' context to really measure the credit rating. How would you see this within the context of what you have said? Because what some countries, some ministers of finance did was to take an African country and take another proximate country in another region of similar level of risk, and they then realize that the risk premium given to African countries seems to be higher than the others. How would you think this can be addressed based on your knowledge of experience with credit rating agencies? So can I start with Soraya first before I go to Wayimi?
Okay, thank you for this question. I think these barriers and these premiums or risk premiums associated with African risk is based not solely but mainly on the hard currency risk. So the risk for African countries to repay their engagements, their debt in hard currencies. And that is opposed sometimes with the capacity, the real capacity of the countries that depends on their macroeconomic performances, the regulatory frameworks, and all the efforts that have been made in our countries in terms of government, internal government, in terms of transparency, in terms of debt management, because overall, the countries, mostly in UMOA, in YMU, we have a central bank that has all the reserves of foreign exchange. So when there is a financial rating in hard currency, this rating cannot be above the rating of the central bank. Other countries of the YMU in hard currencies have speculatory grades because the foreign exchange reserves of the central bank are not sufficient. So this is a bias that is important, and this is something that isn't taken in account when we do rating in local currency. Because in local currency, we measure, we appreciate the capacity of the countries to repay their debt in their currency. So for YMU countries, it will be the repayment, of course, in XOF, but not in euros or in dollars. So this is something that that is really important when we talk about perception of risk. It is a perception of risk regarding the foreign exchange repayments mainly. You said in your introduction that some countries in Africa, even though they are very resilient, even though their performance, I can talk about Benin, Cote d'Ivoire, Senegal, that are quite stable in terms of politics, security, but they have speculatory grades. And some countries that are not so performant have better grades. And what also is quite contradictory is the conditions, the rate interest that countries such as these three, Benin, Cote d'Ivoire, and Senegal have when they make Eurobonds on international markets. These countries have interest rates from 4 to 5–6%. And for me, these conditions couldn't be applied to countries that have speculatory grades. When you have a speculatory grade, you cannot have a loan at 4%. At least you will have a loan at, I don't know, 9–10% because you have a speculatory grade. So the grades that are assigned on the international level to African countries are really based on this perception of risk. We really need to build the confidence of the international market, but based on our real capacity to reimburse in our currency. So this leads me to the importance of building the local currency market in order to be able to maybe do transborder financing, financing in the two XOF zone, the XOF and the XOF zone, that is Central and West Africa, because the liquidity is available. And I think our countries do not need always to go on the international market when we have markets that aren't sufficiently developed. We really need to come back to this priority, that is to build, that is to reinforce and develop our domestic markets, that is also to set the framework to have cross-border financing in all Africa.
Thank you very much, Soraya. Wayemi, over to you.
Yes, thank you. Thank you. I think it's an important question, and certainly it's one that has come up again now during the pandemic, since so many countries in Africa. I think I did a little bit of an analysis last year. I don't know if it has changed, but at that point, 15 countries in Africa had suffered some form of negative rating action, and that could be an actual downgrade, or it could be a change of the outlook from something more benign to, say, from stable to negative, or from positive to stable, etc. So and also that's about half of countries that in the region that have sovereign ratings. So 32 countries have sovereign credit ratings in sub-Saharan Africa. So that's a large percentage of countries that have suffered from downgrades. So this question comes up often at these points where countries are being downgraded. They don't come up when they're being upgraded, by the way. So you have to look at that side. Nobody ever comes up and says, "Oh, this upgrade was really unfair. We actually we actually don't deserve it." I just wanted to say that, but there's very little evidence actually to back this up, and it's important to have evidence. But there are some studies, a few as they are. They're quite old now, and it would be good if we had more of these kinds of studies. The one I'm talking about was done around 2013, and it was looking at this question of whether or not there's bias and what are the reasons for this. And it was written by, I think, University of Geneva, some researchers there. And they did find that there is bias, according to them, which results in a 1 to 2 notch difference between the rating that is implied by a country, an African country's credit fundamentals, and what the credit rating agency actually assigns. And you mentioned the absence of indicators that actually speak to the credit strengths in Africa. I think when you mentioned that there's a Western model that's being applied that may not be appropriate, I don't necessarily agree. I think that these are if you look at what the World Bank and the IMF does in terms of its DSA assessments, you'll find a lot of similarities in some of these indicators. Of course, the DSA is looking at only one thing, but a credit sovereign rating is looking at a much broader aspect. So, but even if you look at what the World Bank says about corruption, which is one of the factors that is used, or institutional development, you don't necessarily find African countries that have high institutional development being rated as in the single B category. So you tend to find a congruence between the assessments of the more the institutions, the public institutions that are deemed fairer, with the ratings, unfortunately, international ratings, maybe not local ratings. So take one, just looking at the going back to the DSA again. I was looking at the recent report from the World Bank, and it showed that in 2013, around only 20% of countries in sub-Saharan Africa were at risk, high risk, or actually in debt distress. So high risk of debt distress or actually in debt distress. So about 9 countries out of 47. By 2021, this had risen to 50% of countries. At the same time, the countries that were at low risk of debt distress in 2013 numbered about 18, now just about 4 at low risk. So has there been a deterioration in creditworthiness on the basis of the way the World Bank and IMF views this? The answer is yes. And of course, when you have a deterioration in credit quality, you have to downgrade these countries. That's coming back to what I said about the role of the fundamental mandate of these agencies is to convey this message to investors so that they don't allocate capital, misallocate capital into riskier credits, more capital than is warranted, and cause all kinds of financial crisis down the line. So I'm not necessarily saying that there isn't any bias, but I think that there also has been a material deterioration in creditworthiness, and that has to be accounted for in the ratings. Now, I would, in terms of solutions, I would really urge a lot of African countries to make the reforms, the SDGs, continue to move towards the SDGs. These are the factors that actually contribute to ratings upgrades, improving the ratings upgrades, as you said, the business environment reforms, the macroeconomic stability reforms, all these factors, human development reforms. Most African countries are low human development countries. You mentioned, and I wanted to talk about some of the factors that may actually benefit, may actually turn out to be credit strength. So for example, Africa's impending demographic dividend. But how do you monetize these trends? You monetize them by investing in education, raising the health level. The pandemic has shown us that our health systems are not where they need to be able to deal with a shock like COVID-19. We're lucky in many countries in Africa that we haven't had the same degree of the health crisis, but if we did, it would have been completely disastrous. Education is also a big issue. So this is how you start to monetize African assets, the youth population. In the country I cover, Tanzania, only 40% there's only a 40% enrollment rate in secondary school. That's not monetizing your human capital. And if you look at the other indicators on human capital, it's the same thing. Someone mentioned the issue about low carbon emissions. That's a very good point, but how do you monetize that? And by monetizing, I mean in a way that would actually contribute to a government's financial strength to be able to get revenues. Tax revenue is really low in many countries. So there's a lot that we can do if we follow the path that the development agencies are pushing for. The reforms, moving towards achieving the SDGs will also have a positive effect on improving credit ratings. I mean, the bias issue is very difficult because no credit rating agency will admit to it. Maybe they will do things internally, and they have been changing their methodologies to make it a little bit more inclusive. But they have to make a difference to creditworthiness. At the moment, things like I said, the dividend, the natural capital, natural wealth, etc., they're not being monetized sufficiently enough. And we don't see the trend maybe going forward. If we saw better indicators and better prospects for achieving the SDGs, then we can come forward and make a stronger case for higher ratings in African countries.
Yeah, thank you very much. I think, thank you very much for touching on those critical areas, the need for us to address the governance reform, the need for us to address the issue of human development reform, and also to deal with the issue of ease of doing business in our countries. These are part of the things that will contribute to the fundamentals of the credit rating institutions. And also for the organizers of this event, ADB, ECA, and UNDP, to see what can be done in watching the African countries' credit fundamentals. And I think this is really great. So I don't know if El Haj is there so that can help us identify contributions from the floor, so that we spend the next 5 or 10 minutes on this and then close. El Haj, are you there? El Haj, are you there? Can somebody help us coordinate the question from the floor?
So are there any questions? Will we take any questions? Or if there's, I don't know if someone online, do we have any questions for the, any questions? Yes, could you give?
Thank you, Ayo. Good morning, good afternoon, maybe. I think this is quite interesting. I wanted to know, how did we make sure, can we make sure that African countries are involved in the process of, rating? Because we found that most of them, it's quite unfair. You can have one African countries and another one who are on the same rating, have the same rating, B or A, etc. But the thing is, when they go to the capital market, they actually get the resources at a very higher rate. So I think to really have insight into the whole process, it will be just fair to make African countries included in the process that affect them. Because by the end of the day, the decision that is taking, the rating, the result actually affect them and affect their ability to access finance. So I think there is need to do that. So what recommendation would you make, apart from taking action on institutional reform, et cetera, which will actually make a lot of sense, but the things which is actually very structural and affect all our countries is that. So what recommendation would you have about that? That is very critical to actually addressing now. Maybe it will not be sorted now, but it's food for thought to see, do a kind of global advocacy, bringing African voice to the table and really challenging the status quo, because otherwise it will never change. And it could be misleading actually sometimes if you look at what is going on right now. Thank you.
Thank you, Igodi. Yes, sir. Yes, sir. Could you give a microphone to the gentleman over there?
Thank you very much. My name is Jason Braganza from Afrodad. Thank you very much to the speakers on this issue of credit rating agencies. It would be nice just if the speakers or the panelists could pronounce themselves, given the current challenges we're facing with implementing the G20's common framework with regard to offering debt relief to many African countries. Do the panelists think that perhaps there is a room, as we think of a different architecture and we think of a different model of doing debt financing, that there's an opportunity now for us to regulate and change the rules that regulate how credit rating agencies' behavior is conducted in the current context? And perhaps is the United Nations the avenue or the space for where this regulatory reform of rating agencies could come from? Thank you.
Are there any other questions on the floor? Any other questions from the floor? Yes, madam.
Thank you so much, Fatuli, senior economist, UNDP, Senegal. Listening to Soraya, thank you so much for those expositions, but I think we are kind of at a crossroad. When you talk about speculative interest rates having to be around 12%, whereas for our countries, it is like about 3%, 4%. It seems like we're targeting the wrong, if I understand you right, we're targeting the wrong indicators. Like for instance, when you say that for speculative interest rates, why are we regarded as speculative? Why not development? If we want to go towards financing certain initiatives that has an impact on the lives of people. So why speculative? And what about other regions? Do you consider them at 12%? Because for our regions, we're focusing like at 3%, 4%. Then another point is that you say we are focusing on having stable macroeconomic indicators, like we're advising the governments, whereas on the rating, it is considering ability to pay in hard currency, basically talking about the reserves. So are we targeting the wrong, are we looking at the wrong doors? Are we knocking at the wrong doors for Africa? Thank you.
I don't see anyone who wants the floor. Yes, sir. Yes, sir. Could you, the microphone, please?
Yes, thank you. My question relates to the role of credit risk in influencing credit ratings. I think in addition to the credit risk, there's also a school of thought that some of the bond issuances by developing countries are not as liquid as those that are issued by developed countries. So the secondary market for bond issuances needs to be strengthened. So the infrastructure for these debt issuances is critical. And an example is the availability of repo markets, or markets where you can actually trade your bonds that you have actually acquired. You don't need to hold on to it for years, but you can actually use it as collateral to access short-term loans, makes these kinds of bonds more attractive. So what would you say about the need and what needs to be done to improve the liquidity of these bonds issued by emerging market countries? And secondly, if you take Greece, for example, as a country that issues a sovereign bond, the backing that Greece has from the European Central Bank also gives it an additional source, makes it less of a credit risk, even though Greece perhaps may be rated at, say, a BB minus. It may get a better rating simply because of the perception that if Greece goes into trouble or cannot defaults, you have the European Central Bank coming to support it. So I think we also need to think about what are some of these infrastructures or institutions that we also need to set up to make small countries be perceived to be less risky because of the infrastructure that surrounds the issuance of those bonds. So more regional approaches could also be thought of as ways to improve the credit risk perceptions of developing countries.
Thank you. May I take my seize the opportunity here to ask just 3 questions. Maybe to the no, it's one question. It's one question, please. One question. Perhaps maybe what are your thoughts, the panelists, the idea of creating an African insurance guarantee agency? One. What about the issuance of commodity-linked bonds? And also recently, a paper has been written by Hippolyte Fokak, the chief economist of Afrexim Bank, which came out in the Brookings Institute in October, which looks at this question of the premium. And he advocates that perhaps the solutions to that is to have some kind of transparency and accountability with the rating agencies and get them to work with us to know exactly what's going on. And secondly, we should deepen capital markets, and perhaps maybe borrowing from the last speaker. What do you think about creating a deep African capital market that would perhaps help address this issue? I don't know. Chair, there's a hand up. Yeah. I don't know how much time we have.
I think we have quite a number of questions that.
So let's leave it there. So you take over. Let's leave it here, and then if there's time and anyone wants to ask a question, then we'll come back. But otherwise, Go ahead, Ayo.
Thank you very much, my dear brother Joe. I think it's really a pleasure for us to have you coordinating the questions and intervention from that side. And well, perhaps before I call on both Soraya and Wayimi to really do that, but let me just do it this way. I will call on Soraya to attend to the first question. How can we involve many African countries in the credit rating? So how do we strengthen the partnership between African countries and CRAs? So that's one thing. And the second one, perhaps I will give to probably to Wayimi on this issue of the common framework DSSI. But again, I can come back if need be, and also to address the issue of enhancing market liquidities based on questions from Bart, that is credit risk versus credit rating. So that's, again, what I intend to really pass across to you. The second one that I'm going to pass to Soraya will be this speculative interest rates based on Fatu's question. The actual interest rate seems to be lower than what they call the speculative interest rate, and why the premium are going that way. And also the issue of regional infrastructural facilities, both Bart and Joe mentioned that. I think those are the kind of infrastructure that we may need to really reduce the risk on the continent. So who is going to kick off? But before then, let me just touch on this regional infrastructure to help reduce risk. I think this is very important. There's hardly anything we can do anything we can think of in terms of reducing the risk as well as the premium imposed on most African countries will be very important. And the fact that we only have individual countries addressing this issue rather than having a kind of regional infrastructure to really back them up in terms of complementary mechanism to support the rating initiative. I think that's one of the things which is really very important, and I love the idea of this creating African insurance guarantee mechanism. I think it's going to help a lot if we can do this, because it's going to give some kind of additional buffer to African countries to be able to deal with the issue of risk. And I strongly believe that the opportunity for us to really harness some of these existing instruments at the regional level to support country will be very, very important, particularly when it comes to the issue of strengthening the governance system and also strengthening the mechanism to ensure that the ability to pay of our countries become enhanced, not only focusing on foreign reserve alone, but other initiatives that needs to be addressed. But I just want to really underscore the fact that there seems to be an issue which African countries need to address, because most of these agencies that are encouraging African countries to invest their foreign reserve, to invest their pension fund, to invest their, the insurance premium fund outside the country at relatively lower rate are the same that are saying you don't have what it takes to collateralize some of the things, credit and bonds that we issue. Which again is coming at serious level of premium. So these are the kind of things we need to reconcile. And I think the three institutions that are organizers of this particular event could help to really see how we can really address that challenge, particularly African Development Bank, ECA, and UNDP, so that we help to build the capacity that will help us to address that gap, so that African countries continue to look inward and mobilize the liquidity and invest it within the capital market to finance development. But also we have to be cautious of the fact that most African countries these days, because of the emergence of commercialized loans and instruments, we are using short-term instruments to finance long-term development, which is extremely very expensive. I think we need to be cautious about that, so that it doesn't lead to debt overhang in 2 or 3 decades. So we need to ensure that whatever instrument we hire goes with the the tenure of development project that we want to put in place. I think this is really, really very important. So, Soraya, over to you for the two questions assigned.
Okay,
if you can do it within 3 minutes, please.
I'll try. Okay, thank you, Dusula. Thank you for these answers. I am totally in phase with you. As far from building another relationship with credit rating agencies, with international credit rating agencies, I think that no one else than African countries, no one else than African governments can build these relations. We need to learn how to challenge the investors on the capital markets. We need to learn how to use the ratings that we have in local currency or in hard currencies in order to challenge the investors, in order to challenge the rates that are proposed on the bonds of African countries. This discussion can be made based on the track records of bond repayments, based on the track record of macroeconomic performances, and as you said, based on the reforms that have been made by the countries in terms of debt management, in terms of public management of funds and all that. We cannot always stay in the position of not taking actions, because we are the one, African countries are the one that make policies on their markets, are the one that lead the trends on the domestic markets too. So I am surprised when sovereign bonds are raised on the market, on the domestic markets, and when governments say that the market isn't sufficiently deep, that the investor base isn't sufficiently diversified. This is their role, this is their action, and I think they must be the one to take actions for it. Another thing that can be worked on is building, as I said, a cross-border market that goes all over Africa, building also a credit rating agency for African countries. That would be a credit rating agency backed by DFIs, like ECA and any other, that knows African risk, that knows how to rate African risk, and that will not be based by the hard currency problem. There was a question about the speculative rates and the interest rates. As I said, this is a question of discussion from the governments. They have to be able to challenge this rates that the international market give them. They have to be able to ask the right pricing for the different bonds, because they have the capacity to repay the bonds that they collect on the international markets. I don't know if I answered the two questions.
Yeah, thank you very much, Soraya. Wayimi, over to you.
Thanks.
3 minutes.
I'll try very, very hard. Thank you so much. These are very interesting and talk about the DSSI. That was a point that came up in a broader question, but some of the feedback that we've received from the market in particular and their response to the DSSI and the way they reacted to it is that initially the communication was not clear. Private investors were not included in the discussions in the beginning, and they found this unfair. And like I said in the beginning of my presentation, when there's uncertainty, there is this overreaction and there's this shutdown. And so we saw in the case of Ethiopia in particular, with Moody's downgrading, just because Ethiopia said that it would participate in the DSSI. Of course, we also know that it subsequently downgraded Ethiopia to the C rating category after it said it would take part in the common framework. So you had this problem of miscommunication in the first place, not understanding what this meant for debt repayments to private creditors in the beginning, causing a massive spike in the spread between yields on risk-free and emerging market credit. And then subsequently we saw a resolution when there was more clarity that the countries that were benefiting from DSSI were not actually going to defer payments on Eurobonds and private credit. So then we saw a market improvement in we saw a market compression in the spreads of yields, and as Ayo mentioned, this led to an actual surge in Eurobond issuance, particularly in this year, and we saw some very we saw the largest, in fact, from Nigeria, 4 billion issued on the Eurobond in these market circumstances. So that's what I think I should say on the DSSI. I think it was a misguided move by Moody's to downgrade Ethiopia before actually understanding what the parameters of this instrument was, and then of course when the common framework came into play, Zambia, Ethiopia, and Chad. Chad is not a country that issues bonds. Have decided to take that up. And the problem is, if you look at what happened with Greece, Greece did exactly the same thing when the same thing happened in the case of Greece, I should say, when the European Union negotiated a deal, a debt restructuring deal, which triggered the clause for rating agencies to consider it as a default event. And they're just applying the same principles, unfortunately. And like you say, is this an area for that regulations can step in to resolve? It's something to be considered by the regulators to say to give the conditions under which these kinds of contracts can be considered fair or not fair in different circumstances. There was a question about the first question to do with differentials that even within Africa, countries can have with the same rating. They could have very different yield outcomes, and that is very true. And there are things that can be done in the short term. Because like you mentioned, some of the reforms that are needed to really improve creditworthiness are long-term agendas. So the countries that have been successful in doing this, they've been successful because they've communicated their own story apart from the ratings that they have. They have proven their creditworthiness. Nigeria has done this successfully. Benin has done this successfully, but then again, Benin's rating trajectory is better than most countries. It's one of the countries that's actually upgraded, not downgraded. So again, Rwanda has done this successfully. Countries that haven't done this successfully include Ghana. And in Ghana's case, for example, the market perception is that it has a very high dependence on external debt, and that's not the way they see it in cases like Kenya or Rwanda or some of these other credits. So there's I think someone mentioned there are other, in the chat, in the question and answer, there are other factors that determine the yields, not just credit ratings. And African countries do have a say. They can make a stronger case when they go on their roadshows to publicize and sell their bonds. So it's not really just down to the credit ratings. And also making the case that you will use the funds for the reasons that you say you're going to use them for, and also and demonstrating a track record of doing this. These are things that in the short term can really help governments reduce those rates by, you know, up to 1 percentage point, which is not to be sniffed at. Someone asked about commodity link.
Please summarize.
Oh, sorry. Okay. I think maybe I should leave it there. There's some other questions on the table, but I think we're running out of time. So thank you.
Ayo, I'm getting signal that we should wrap up.
Yes, that's what we want to do now. Yes, thank you very much. Thank you very much, Soraya, Weyeme, and colleagues that have contributed to this. And I see Joe too as a panelist because he helped us coordinate that particular process effectively. So thank you very much. What I could just summarize on the basis of this particular session is that, one, we have to avoid using short-term instruments to finance long-term development. And one of the suggestions is project-based bonds to avoid maturity mismatch. So that's one. The second one is the need for us to really leverage the possibility of regional infrastructure to reduce risk and also to support credit rating. This is one of the initiatives suggested in terms of the African Risk Guarantee Scheme and so many other ones that we can put together to accelerate this. Third, partnership is very important, not only in terms of capacity building, but also in addressing the perception about credit rating on the continent. So we have to really work together with these credit agencies so that we understand their internal mechanism and to be able to really make sure we get the issues right. The fourth one is enhancing credit fundamentals, including improving our ease of doing business, improving the governance structure, building our human capital, and also boosting the ability to pay of each country. The fifth one is that we still need to really leverage what we call the optimal use of existing dormant or suboptimally utilized capitals, like sovereign wealth fund, like pension fund, like our foreign reserves, as well as the insurance premium fund, plus the unutilized bank funds. So these are things that are there that we need to really utilize to beef up not only the capital market, but to support development process. And finally, we need more studies to be able to establish the key facts for us to effectively engage the credit rating agencies and even the actors in the capital market in order to strengthen and develop our capital market and ensure that Africa is not really priced out of the entire process. So let me use this opportunity to thank all of you for making this session very interactive and also very result-oriented. I really appreciate, and I want to also conclude by saying thank you to the organizers, the African Development Bank, the United Nations Economic Commission for Africa, and the United Nations Development Program. So thank you, and all the best.
Thank you for the excellent moderation by our good friend and brother Ayo. Thank you. So we've come to the end of this session. I believe the program is lunchtime, I think. So I think we are short of time. We're supposed to come back at 1, right? So please, let's go and have a quick lunch and return here at 1 o'clock. Thank you.
Okay.
I think so. It's okay.
Yeah. Thank you.
Wait, did you send me the documents?
Yeah, I did. I sent you, but I don't know. Did you get it? I hope you got it. It went.
I'm not sure.
Anyway, it doesn't matter now. So
yeah.
yeah.
Well, thank you.